Welcome back to the channel, everyone. We're Investment IQ Insights, and if you're new here, this channel is all about helping you achieve financial freedom by making smart decisions. But today we're flipping the script. Instead of focusing on what you do, we're diving headfirst into the top 12 mistakes that can drain your bank account faster than you can say margin call. That's right, we're talking about the top 12 tips to lose money in the stock market. Before we get into it, make sure to smash that subscribe button and hit the notification bell so you don't miss out on future videos about how to build wealth. All right, let's get started. The first, and arguably the biggest mistake you can make, is going in without a plan. It's like setting sail without a map or a destination in mind. You might end up somewhere, but it's probably not where you wanted to go. A solid financial plan should outline your financial goals, your risk tolerance, and your investment strategy. Without it, you're just reacting to the market's every whim, buying high on emotion and selling low out of fear. Trust me, we've seen countless people jump into the market thinking they'll get rich quickly, only to lose their hard-earned money because they had no clue what they were doing. They were chasing the next hot stock tip, buying on margin, and ignoring the fundamentals of investing. Don't be that person. Take your time, do your research, and develop a well-defined plan. Your future self will thank you for it. Mistake number 2, trying to time the market. If there was a surefire way to time the market perfectly, we'd all be millionaires, right? But the truth is, even the most seasoned investors can't predict with certainty when the market will go up or down. Trying to time the market is like trying to catch a falling knife. You might get lucky once or twice, but eventually, it will catch up to you. The stock market is driven by countless factors, many of which are unpredictable. Economic data, geopolitical events, and even investor sentiment can all impact stock prices in a matter of seconds. Instead of trying to predict the unpredictable, focus on what you control, your investment strategy. Invest consistently over the long term and don't let short-term market fluctuations derail your financial goals. Mistake number 3, letting fear and greed control you. These two emotions are the enemies of sound investment decisions. When the market is on an upswing, it's easy to get caught up in the hype and let greed take over. You see your portfolio growing and you want more. This is when you're most likely to make impulsive decisions, buying high and ignoring the warning signs. On the flip side, when the market takes a downturn, fear can set in. You see your investments losing value and you panic, selling low and locking in your losses. Remember, the stock market is a marathon, not a sprint. There will be ups and downs along the way. The key is to stay disciplined, stick to your plan, and don't let your emotions cloud your judgment. Mistake number 4, having unrealistic expectations. Now, I'm all for setting ambitious financial goals, but it's important to be realistic. You're not going to turn $1,000 into $1 million overnight. The stock market can be volatile, and while there's potential for high returns, there's also the risk of significant losses. Don't fall into the trap of believing every hot stock tip or get-rich-quick scheme. Remember, investing is a long game. It's about slow, steady growth over time. Set realistic expectations, be patient, and don't expect to get rich quick. Mistake number 5, lacking patience. Speaking of patience, it's arguably the most important trait for any investor. As I mentioned earlier, the stock market is a marathon, not a sprint. Too often, people jump into the market expecting to make a quick buck, only to get discouraged when their investments don't skyrocket overnight. This impatience can lead to impulsive decisions like selling low out of frustration or chasing the next hot stock. Remember, good things take time. Building wealth through investing requires patience, discipline, and a long-term perspective. Don't let impatience derail your financial goals. Mistake number 6, failing to do your own research. In the age of information overload, it's easier than ever to get caught up in the hype and follow the crowd. But when it comes to investing, blindly following others can lead you down a dangerous path. Just because everyone else is investing in a particular stock or sector doesn't mean it's the right investment for you. Before you invest in anything, take the time to do your own research. Understand the company's financials, its competitive landscape, and its growth prospects. Don't just rely on hearsay or what you read on social media. Remember, knowledge is power. The more you know about your investments, the better equipped you'll be to make informed decisions. Mistake number 7, investing with a short-term mentality. Short-term thinking is like kryptonite to your financial goals. If you're constantly focused on the next few weeks or months, you're likely to make emotional decisions based on market fluctuations. Remember, the stock market is cyclical. There will be periods of growth and periods of decline. But over the long term, the market has historically trended upwards. Instead of trying to time the market or chase short-term gains, focus on building a diversified portfolio that aligns with your long-term financial goals. Mistake number 8, trying to get rich quick. Let's be honest, we'd all love to find that one magic stock that will make us millionaires overnight. But the truth is, get-rich-quick schemes are just that, schemes. If it sounds too good to be true, it probably is. Don't fall for the hype. Building wealth takes time, discipline, and a commitment to making smart financial decisions. Instead of looking for shortcuts, focus on the fundamentals of investing. Invest in quality companies, diversify your portfolio, and be patient. Remember, slow and steady wins the race. Mistake number 9, making emotional decisions. We've already touched on this, but it's worth repeating. Emotions and investing don't mix. When you let fear, greed, or any other emotion dictate your investment decisions, you're setting yourself up for disaster. Remember, the stock market is driven by logic and fundamentals, not emotions. Before you click the buy or sell button, take a step back and ask yourself, am I making this decision based on logic or emotion? If it's the latter, it's probably a good idea to reconsider. Mistake number 10, acting on speculation. Speculation is like gambling with your hard-earned money. You're essentially betting on rumors, hearsay, or gut feelings rather than solid information. While it's possible to make money through speculation, it's incredibly risky and not a sustainable investment strategy. Remember, investing should be based on facts, not fiction. Before you invest in any company, do your due diligence, understand its financials, and assess its growth potential. Don't let speculation lead you down a path of financial ruin. Mistake number 11, following the herd. Remember the dot-com bubble or the recent meme stock frenzy? These are prime examples of what happens when investors blindly follow the herd. Just because everyone else is buying a particular stock doesn't mean it's a wise investment. In fact, it could be a sign that the market is overvalued and due for a correction. Instead of following the crowd, do your own research and make investment decisions based on your own financial goals and risk tolerance. Last, but certainly not least, mistake number 12, failing to practice discipline. Failing to practice discipline is a surefire way to sabotage your financial success. Investing is a marathon, not a sprint, and it requires patience, perseverance, and a commitment to your financial plan. It's easy to get sidetracked by market noise, emotional impulses, or the latest investment fads. But the key is to stay focused on your long-term goals and resist the urge to deviate from your plan. Remember, discipline is the bridge between goals and accomplishment. So there you have it, the top 12 tips to lose money in the stock market. Remember, investing can be a powerful tool for building wealth, but it's not without its risks. By avoiding these common mistakes, you'll be well on your way to achieving your financial goals. As always, this video is for informational purposes only, and is not intended as financial advice. Before making any investment decisions, it's crucial to consult with a qualified financial advisor to determine the best course of action for your individual circumstances. If you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more videos on personal finance, investing, and building wealth.